Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you the market wrap-up for the week of May 29th, ending June 2nd. This week was actually a short week. The Memorial Day holiday was on Monday, so there were only 4 trading days. However, while we may have been short a trading day, there was no short or lack of intrigue for the week. This week on everybody's radar screen, of course, was the debt ceiling negotiations in Congress and the dysfunction in Congress and the expectation that, or at least the possibility that they may have driven us into a default. Fortunately, that did not happen. They actually, both houses of Congress passed the debt ceiling, and in fact, actually even put it off for an extra year. Obviously, that was in nobody's interest except theirs. Of course, they basically put it off for an extra year so they wouldn't have to contend with it in the next election cycle. However, we are the beneficiaries of that, so that we will not actually have to listen to this for at least about another 2 years rather than next year, which is usually what ends up happening. So anyway, that was the story here. In fact, if we actually look at today's market action, this was the day after it was passed in the Senate, where and then now, of course, it's going to go to the president's desk to be signed. So we can see here, obviously, we had a huge reaction today here. It was the Dow futures and the Dow Jones Industrial Average was up about 700 points, which is approximately a 2% move there. Pretty much everybody joined the party except for Verizon for some reason and for Salesforce. I don't specifically know why, but at any rate, they were the only 2 that really didn't join the party. Everybody else pretty much experienced some green, and particularly 3M, Caterpillar, Dow. There was a whole lot of winners in the Dow there. So that was the story with that, and that's sort of the macro stuff that's under the hood of what was sort of driving this week. So in fact, I'll show you in a second when we look at the week, we can see to some degree things were in sort of a holding pattern, and you can kind of see this was sort of a somewhat of a small drift down. But we can see we were obviously kind of range bound until we got to Thursday, and then we got Thursday and then Friday here, and that was of course coinciding with the debt ceiling package in both the House and the Senate. And again, at this point, it goes to the president's desk, and probably going to be signed either tonight or over the weekend, avoiding the Monday default that was on the horizon. So anyway, for this session here, here's the game plan. We're going to go through and take a look at the market action both for the last week, and then also look at it for the last rolling month, in order to kind of see where there is relative strength between the SPY, the S&P, the Nasdaq, as well as the Russell 2000. And we also throw the bond market in there just for perspective. After that, we'll take a look in those same 2 timeframes, the week and the rolling month, and we'll take a look at that in the context of the major industrial sectors. Financials, energy, consumer staples, and utilities, all of those. So we'll look again for relative strength and weakness in there. We'll then actually look at the SPY and the Qs, and we will look for potential trading levels for us. We tend to look at these, what are referred to as supply and demand levels, which are characterized by demand levels are where there are exhaustion of sellers at a particular area where price consolidates, and we look for pullbacks into those demand levels for bullish trades. And similarly, above where current price is, we look for what are referred to as supply zones. That those are characterized by exhaustions of buyers, and so when price returns to those regions after a bearish move out of those the first time, price returns a second time, we expect oftentimes to see another repeat of that behavior, and that is the setup for a bearish trade. And of course, we'll see that in a second when I go to the live charts. And then lastly, we'll take a look at a few other symbols. We'll look at the FANG stocks, which of course now are called really the MANG stocks, because of course Facebook is now Meta. So we'll take a look at the MANG stocks, and then we'll also throw in Tesla for good measure. So at any rate, that's the game plan for this session. Before I do that, of course, the ubiquitous disclaimer. Precision Trading Labs, we are not financial advisors. We are not fiduciaries. We are not broker dealers. Everything that we present to you and to our subscribers is purely for information and educational purposes only. And in the case of our subscribers, it is aimed at essentially teaching them to be competent and confident traders. So if we look at the market action for this week, and again, as I said, there was only 4 trading days here. So this is a percent change chart based on the close of last Friday, the 26th. And then from there, you can see that the first trading day was the 30th, 31st, the 1st, and the 2nd. So there were 4 data points in here rather than 5. So if we look here, we can see the Russell 2000 for the week was actually the big winner at about 3.33% up. The SPY and the Nasdaq were both up a little less than 2%. And then we can see that the bond market was down about 1%. So that was the story for the week. If we then move on to the sectors here, here is the market action for this week for the 13 major sectors. So we can see here that consumer discretionary, real estate, materials, those were kind of the bigger winners there, or not that they were huge winners, but they were up about 3.33%. We can see right there that dot there. There's the S&P, and that's up about, as we said, up about 2%. And then on the low side here, consumer staples were certainly effectively only the weakest of the sectors, and that was just barely break even here. And then we sort of have this cluster of a whole lot of the sectors that are kind of sitting in the middle. But in terms of the ones that were up at least 2%, that starts out here more or less with the transports, and then we have the financials, the industrials, materials, real estate, and consumer discretionary. Okay, and as we say, when we find relative strength in a particular sector, what we're basically then looking to do is oftentimes to find the strong stocks within the strong sectors and utilize those as the basis for bullish trades. And they take 2 forms. At certain times, we will actually put on a breakout trade when our setup is there for a breakout, or we will then look for pullbacks in lower time frames into the demand zones that I'm about to show you in the live charts, in order to then leg back into the impulse move up in terms of a bullish move. Okay, so that's what we do with demand zones and stocks that are showing relative strength. Of course, for relative weakness, we do the exact opposite. We identify the weak sectors and then look for the weakest stocks within those in order to then look for breakouts on those really weak ones, or for short-lived corrective rallies up to supply zones. And at that point, then there is the expectation, a large percentage of the time, that price will then roll over from those supply zones, and then that will be the basis for bearish trades. And of course, those bearish trades can be expressed either by literally shorting a symbol, or of course, one could then use any number of bearish options positions in order to express the bearish trade. And of course, similarly, the same goes, of course, for bullish trades. So that was the story for the past week. If we then go to the rolling month here, this goes back for, now that the week is over, this goes back to the last 5 trading weeks. So there's approximately 22, or let's say 21, 22, 23 trading days in here, depending on exactly how many holidays there were. And I guess there was really only one holiday, Memorial Day. So actually, there would be 24 trading days in here. And this shows again. So this goes back for 5 trading weeks. So here is our reference point here, and that was March 28th. So that's where this percent change indication comes from. So this is the 0 point for everything. So we can see that, of course, the tech has been on top. So that's there's the XLK there, and then there's consumer discretionary and communications. And of course, communications are oftentimes very closely tied in with tech. So that's not too much of a surprise that that's up there as well. And then kind of in the middle here, we have the industrials and the S&P itself and the transports. And then these are kind of the weak ones here. These are all the ones that were negative over the past month here. well, really the last 5 weeks. And you can see these are all negative, everything down from financials to energy. So more or less, you can see, even though the market itself is up in terms of the rolling month, and I'll show it to you in the S&P in a minute, because we're actually nearing a 52-week high. You can see that a relatively limited number of the sectors are actually what's holding the market up, headed, of course, by tech. Because really, as you can see, there's the vast majority of these, particularly for the last 5 weeks, they're all down. And particularly energy, of course, has been kind of the dog here for the last several weeks. So at any rate, there's the rolling month. So here's a look at the SPY. And if we look here, first of all, this is a daily chart of the SPY. So of course, each one of these price bars represents 1 day of market action here. Right here, this vertical line here, this dashed sort of light blue line here, this is what we were looking at. In fact, let me just slide this over here. This is what we were looking at last week. Okay, so this is the 26th. Okay, so this is last Friday here. In fact, let me just bring that up there to make sure I got the date right there. So here was May 26th, correct? So here is this is what we were looking at last week. Okay, and at the time we were looking at this last week, we were actually looking at a supply zone that was right here in the 2-hour chart here. If we broke this down to a 2-hour chart, price came down, dropped here, went sideways, and then notice that gap here. So this was an area where there was an exhaustion of buyers here, and then price spent relatively a small amount of time in here, really less than a day. And so when price came back here, there was the expectation that price would essentially be kind of stopped by this region. And it did. It came up here. It basically came right up to the front door here. You can see it dropped from there. It then came back here. It's kind of got smacked down for 1 day. But then the euphoria of the debt ceiling came into play. And so as a result, this area was now driven through and was negated. So essentially, we can just essentially wipe this now off the screen here, and this no longer has any meaning for us here. Okay, so now we are up here. Okay, and if we go back here now, okay, again we have the debt ceiling agreement. This is now a daily supply zone. Price rallied here, went sideways. Okay, notice then a tiny gap there, a bearish candle, and then another major gap there, and another very bearish candle here. Okay, so this is an area of anticipated downward price pressure. Now, having said that, because of the euphoria of the debt ceiling agreement, price is now up in here. I would not be racing though immediately to the short this. We're right here, this jagged blue line up on top. That's actually the 52-week high for the SPY. Okay, so so like I said, we're kind of in this region here where we're approaching the 52-week high, and we have the euphoria of the debt ceiling agreement. So again, I would not be racing to short out of this region here. So but the thing is though, if you did that and you actually ended up playing some kind of breakout here, which is a possibility, for us in looking at this, the next really clean area of supply is then up here around about 10 or 11% from where we are now. So that's a very, very long way up. And the reason I say that is because right here, we had this area where essentially this was a little kind of a small area of supply here, and then price dropped from here. Right here, this is this kind of triple top right here. This is an area where prices, we can think of this as resistance, where price has come up and gotten rejected out of this 2 or 3 times, like 3 times here. So when price comes back here the next time, it could get rejected out of there. But I would use this as more of the basis for a breakout trade, and I would not just automatically expect price to get smacked out of there unless we had some kind of confirmation in a lower time frame, and that at which point we're expecting price to perhaps roll over from here. So neither of these are sort of automatic trades for us, and that's why I said, in a sense, that the first clean area of supply is right there. That's a rally, a base, and a drop there. And it's kind of very clean, and and price has not been back there since. So this is all kind of one region here. And so if price would get back there, we would certainly expect to see a push down from there. But again, that's kind of a long way away. Okay, right now, in terms of, so that's what's going on above, where there might be a couple of potential breakouts. And of course, having said that, it's inevitable when price goes up here, there are going to be certain places where it will get smacked down here. It's just that from a supply and demand perspective, we are really not confident about what we would do in sort of other regions, in various places in this chart, until we actually get the clean supply or complete, in terms of a clean supply zone. So it's not to say again that the price is not going to come up here and get smacked down here, but our methodology and our core principle suggests that there are certain places in the chart that we have some confidence about what's going to happen, and then there are other places we just don't have that confidence because it's not our trade. And so as a result, some of you might go look at this and go, well, I would certainly, if this thing gets to an upper Bollinger Band or something like that, and it's overbought, well, I would short it there. And that's perfectly valid. It's just on its own, that's not our trade. Having said that, we would look at that as an odds enhancer for our trade in connection with some kind of supply zone. So there is that. On the downside here, if price would actually start to pull back from here or, anywhere above, this is an area of demand in here where price came down, consolidated, and rallied strongly. I would be a little hesitant, though, to automatically go long out of here, because this is entirely a news-driven demand zone here, again, because of the debt ceiling rate. So, okay, so again, I would be sort of cautious if we ended up getting a pullback here. I would be a little cautious about just automatically putting on a bullish trade from this region here, which is sitting at around 418 and 419 there. Again, I would be a little cautious about that. After that, right here, there was a 2-hour demand zone right here, and price has actually kind of kissed the front of this zone a couple of times, and we've gotten these bounces out of it. But because there's been essentially only incidental contact here, it's quite possible when it comes back here again. Normally, there's an expression, the first test is best. In other words, once we have a demand zone here, we usually like to sort of, each time it comes back, we think of it as weakening, almost like taking a hammer and kind of, a sledgehammer and going up against a cement wall with it. Each time you hit it, it weakens. Having said that, though, this has just barely kissed the front of this zone twice. And so if price comes back here again, it's quite possible we may get another bounce out of that. Okay, in relation to current price, that's about 5.5% down from where we are now. And that blue region that's above here that I just highlighted, that's only about 2% down. Okay, so we got that region that's 2% down, and then again we got this region here that's about 5.5% right there. Okay, and then there's also another 2-hour zone and a reversal point right here. Price, if we blow this up, we can see right here. Price came up. Notice we have this kind of this spinning top doji-like candle, and then notice that major gap up here. Major gap in a bullish move. So this is a reversal point, and we would expect that we would see if it actually came down that way. And of course, that's 7.5% down. So again, that's a fairly long way down. So again, this region below us is about 2.5%. So we would definitely, if we ended up seeing a pullback, we conceivably we could be looking for a bounce from there. And then after that, it's just kind of wait and see about what it does above here, because of the fact that we really don't see any really clean supply, particularly in the daily chart, till about 11% up there. Okay, so that's the story with the SPY. If we now go to the Qs, slide this over a little. So here's where we are in relation to current price. Again, this is that same, more or less that same region that we saw in the SPY. You can see it's now sitting in the middle of essentially the same region on the Qs here. If I go back here, we can see right there's a drop, a base, and a drop out of there. Okay, and then so this is a supply zone again, and so under other circumstances we might actually expect price to roll over here, but we can see price came up here, okay, and then started to drop, But now again, the last 2 days of the euphoria of the debt ceiling negotiations is now pushing into this zone. And again, that may very well carry through on Monday. So again, I would not look at that as an automatic bearish trade here. Okay, but then a short distance above here, about 2% higher, there is another region right up here. So if price continues to move up, okay, right here we have an area where price rallied up, and then notice that very, very bearish move down. Again, there's a gap. And so this could be an area of where there's downward price pressure. I am a little hesitant about that because of this prior trading that was also kind of pushing down from this area. But on the other hand, price did sort of push through this prior area here. And in a sense, this green candle really shouldn't have formed if there was some supply that was left in here. And it actually pushed through by what is that, about $2. So, and then essentially now we have this reversal point here. So it's quite possible that this is still a valid supply zone right up here. Okay, and that's about 2.5% from current price here. After that, below here, there's really nothing in terms of, let's say, really clean. We have this thing that's about 7% down. These are 2-hour levels in here. But in fact, now that I looked at this again, and I failed to update this, but now that I'm putting this back in here, this is really the same level again that we saw in the SPY chart. Okay, so in a sense, we could be looking at a pop out of here if we get a pullback. But again, this was news driven again from the debt ceiling negotiation and success. So again, I would not just automatically go long out of here. So that's the deal with the Qs. And if we now take a look at some of the other symbols here, let's take a look at Apple. So here's Apple. Here's where we are now. Again, Apple had a couple of had a robust push up earlier this week, and then today actually only went up just a bit. Yesterday it had a nice move on the first day of the debt ceiling finish, but then today more or less only went up a bit. You can see up about 0.5% versus a lot of the 1% plus moves of a lot of the other stocks. But in terms of now, if we were going to look for a pullback, there's really no clean demand here till about 8% down from here. And right here, there's a drop. You can see that, and then price reversed out of here. If we then drop this into a 2-hour chart, we would then see kind of a 120-minute 2-hour demand zone in here. And then similarly over here. Okay. And in fact, you can actually see that there is a drop, a base, and a rally here. And this is actually, we can see that actually in the daily chart here. Bearish candle. This is an indecisive candle, which is where its open and close is significantly less than half of its total length from high to low. So then we kind of look for that in the base. And then, of course, this gap and this very bullish move out of there. Okay, so this is an area where we would expect, particularly somewhere in here, we could very easily expect to see a bounce. And then right down here, about 10% down, this is an area, again, we had a very bullish move out and some consolidation. However, I'm a little wary of it because of the trading that happened right before this. So I would not be, I'm not really enthused about that. And that's why this has a different color box here. Okay. Like I said, the ones that really sort of meet our criteria, those are the ones that we highlight in yellow. Okay. So there's the deal with Apple. If we look at Amazon. Okay. Here's where we are now. Amazon is actually knocking on the door of a supply zone, which is right here. Price dropped there, consolidated. Then we have a gap and a drop down here. So it's possible that we could end up seeing we could see a drop out of here. Right now it's knocking on the door. And again, I would be very patient about going short on Monday until we see what transpires. After the debt ceiling and success and the big pop today. obviously most people, and I know it's perfectly reasonable to think, oh, there could be some profit taking after, that huge move of 700 plus points on the Dow today. But, there could be sort of irrational exuberance, as the expression goes. And so you could just see a real push into this zone. So I would not just automatically think that I would short out of here. Even though, in fact, we were actually sitting, if you look right here, you'll see that there's that thin orange line there. That's the upper Bollinger Band, that two standard deviation Bollinger Band. So it is at the upper Bollinger Band. Price is obviously then, by definition, stretched from there. So, we could see it could roll over, but again, I would not be looking for it unless I saw some evidence of that. Right here is that same zone that we've seen in a number of in the S&P charts, as well as the Qs. Right there's that same zone that I was showing you in those other charts there. But again, the pop out of here. Okay. Well, actually, this actually preceded the passage of the debt consolidation. So in fact, this is actually a legitimate demand zone in here. And in fact, if we then take a look at where it's located here, that's about 6% down from here, from current price. So this is actually a reasonable zone where we could look for a bullish trade if we got a pullback here. And that's located around about $117. Google here. Okay. Right here, we can see there's no clean supply up here until about 13% above where we are there. We can see that right here. Right here, we have that rally, that base, and that drop there. And in fact, if you recall, we kind of saw that in a couple of the other charts that we looked at. Okay, so there's that level that's there. Right here, this has been knocking on the door of a level that's the supply zone that's sitting right above here. And that's this right here. There's a drop, a base, and a drop here. We're looking at the daily chart here. If we broke this down to a 2-hour chart, we would then see the base that's in here. And of course, if you look at the charts here, anytime that you see overlapping bodies and wicks, that essentially means that there is a story in there. You just can't essentially see it because you're not using a fine enough lens. Having said that, after you look at a few zillion charts over a period of years, you have an innate sense of when you look at this, and you can almost visualize what's sitting in there. And there's a 2-hour level that's hanging out in there. Okay, so it's knocking on the door of that here, and you can see it actually came up here and essentially is consolidated under here. But for the same reason, again, I would not be looking to short this unless there's some real evidence in a lower time frame that price is starting to roll over here. Because again, this could just burst through on Monday if there is still the exuberance about the relief rally from the debt ceiling. Below here, there's a 2-hour zone here around 4% down, and then really there's really nothing clean down here until we actually get to there, and that's about 6% down. There's a rally, a base, and a rally there. So that's what we're looking at on Google. Looking at Facebook, Meta. Facebook, Meta here. There's actually a massive unfilled gap that it's been very gradually starting to fill. Okay, right there is that massive gap that formed, presumably after that bad earnings announcement last February, and you can see now it's basically come up to its 52-week high here. And that's right there. There's a little blue cross. You can't see that, but we're at the 52-week high here. And so, all through here, this is all starting to fill that gap. And it's quite possible it may continue up to do that if the market holds together. At that point, then there's about 15% to go in terms of actually reaching that gap up here. So we'll take a look and see, what ultimately happens here. But there's a ways that Meta can actually go here. Okay. On the other hand, if this thing would start to roll over and pull back here, then there is there's a level right here, a demand zone that's right here, and we're looking at let's see, where are we here? That's about 8%, 9% down from where we are now. Structurally, it's not the greatest one in the world. This is really the one that's kind of we would have greater confidence in. But that's 13% of the way down. So that's again a long way down. So essentially, that's just a way of saying we really don't see anything on a pullback basis for Facebook, at least for a while. Obviously, other people can look at this chart and come up with have a different conclusion there, but that's our view of it. And then let's take a look at Netflix here. Netflix, there's a zone that's sitting above here. Again, that's sitting at its 52-week high. You can see there is the blue crosses there. And if we take a look right here, and we look above. Okay. Again, if we drop this down into the 2-hour chart, this overall, you can see right here, there was these overlapping wicks here. These overlapping wicks are essentially kind of just shielding, showing a 2-hour level in there. In fact, let's just take a look at this one here. So if I drop this down into the 2-hour chart here. And we roll this back here. Okay. Notice right here, okay, price comes down. We have this green consolidation candle in where there's a pause there. There's another pause right here with this red candle that follows here. And then notice right here, there was actually a gap down. It quickly wicked back up into this region, and then it kind of plummeted again and kind of dropped down with a great deal of energy from there. So again, when price returns to this region where there was an exhaustion of buyers, we would expect that we might actually see some downward price action from there. Okay, that's about 7% up there. Okay, so again, a lot of these trading zones, mostly they're a fair distance away. Because if we notice right here, here's an area of kind of sloppy resistance here. This kind of triple top there. And this could reject price here, but again, we would have to be very cautious about seeing that, because this is certainly not clean supply here. This has been back and tested a number of times, and so while resistance basically tells people, oh, the more it hits resistance, the stronger it becomes. In fact, when we're looking at supply, it's the exact opposite. The more often it's hit, the more it weakens. So as a result, we would not just automatically short from there. Similarly, this is an area of clear resistance here. But again, I wouldn't be racing to short there. And so that's really the first clean area of supply there. Okay. Below, in terms of if we were looking for a potential long here, this area right here, it's kind of sloppy. So no, I'm not involved. I'm not in love with it. And in fact, this is all the relief rally right here. So I'm not in love with any of this. And so right down here again, this is a long way down here. So I really don't see anything on Netflix there. And then lastly on Tesla. So here's where we are at current price here. And if we go back to here, you can see there's a clean demand zone that's about 13% of the way down. There's also something right here in this region right here, and that's about where is that? That's about so that's about 7% from where we are now. So we would need a 7% pullback here in order to then find a long trade here. And again, this would be this isn't the 2-hour chart here. So at any rate, there you go. That's the market wrap up for last week, as well as some of our trading zones. I hope you found what I presented here informative and interesting. If you did, please give a like to our YouTube channel. Subscribe to it, please. And also, if you click on the schedule a call link, either I or myself or my partner, Ryan Nocera, we would be delighted to tell you about PTL, the way we work with our subscribers, as well as take a look at some symbols that you might be looking at. And so, again, click on it and give us a call. Anyway, that's the story. This is Mitch Firestone with Precision Trading Labs, and I will see you guys next week. Take care. Bye-bye.